Hi, welcome to today's video. Why the current uncertainty in the financial markets was thanks to the trade conflict between the US and China. Yesterday's fall in the stock markets should also be seen together with EU Commission's downward adjustments of the economic growth in the EU area for 2019. Though there wasn't a big forecast adjustment of the economic growth for the EU area, the adjustments for Italy and Germany gave uncertainty to the financial markets. Economic growth in Italy was forecast to be only 0.1% this year, half of what was forecast in February. Budget balance was forecast to be minus 3.5% of GDP by 2020. The announcement gave more conflict between the EU and the Italian government. Germany's economic growth was forecast to be 0.5% instead of 1.1% forecast in February. Even with gradually better economic indicators from the EU, the Commission still believed Germany's economy was uncertain. If the trade conflict between the US and China continues, the economic growth in Germany and EU will be negatively affected even further. The fact that the financial markets have been reacting so strongly of the trade conflict shows that investors still are not certain about the global economy. The positive development in the stock markets at the beginning of 2019 was mostly because of the phase change in monetary policy from gradually rising interest rate to a pause in further rate hikes. Economic indicators from China had been improving, according to Citigroup Economic Surprise Index, which measures how much economic indicators surprise markets' expectations. Chinese economic indicators had been better than expectations since April. This might be thanks to Chinese government's market interventions. The data of China's balance of trade released today, though, was worse than expected. And that's it for today's video. Check the video's description for more details. Thank you for watching.